starting to put news back out in the market. Portfolio managers are getting ready, trying to position their portfolios like I used to do, institutional money manager for the last 3 months of this year, but more importantly for the calendar 2022. So wanting to see how their portfolio should look like starting next year.
So perfect. That's what I want to talk to you about today, of what we can expect, like I said, for the remainder of the year and as we start up 2022. On that note, Goldman Sachs coming out downgrading its economic outlook over the weekend, citing the Delta variant and fading fiscal stimulus as a concern. Also, Morgan Stanley downgrading U.S. equities to underweight. They said we see a bumpy September, October as the final stages of a mid-cycle transition play out. Now, I know you've been calling for a stock market correction here. Is it right to say a major one?
That'll depend on how active the Fed wants to be in terms of removing the punch bowl, the stimulus that they've been putting into the market. But I think those calls are accurate. Go back to the theme we started earlier in the interview, Daniela. Markets had a huge run. I mean, had a massive run off the COVID lows, had a huge year this year. Again, putting my institutional money manager hat on, you always think about what's next year going to look like versus this year. And if you look at the comparisons in 2021 versus 2020, I mean, the company's earnings this year are comparing to 2020 levels where there was no activity at all. Restaurants were closed, hotels were closed, airplanes weren't flying. So every company's earnings, revenue, margins are going to look really good this year when you compare it to 2020. You look out to next year, you're going to be comparing more apples to apples, where you have activity in 2022 versus activity in 2021. So those growth rates for revenue, earnings, margins are naturally going to decelerate next year versus this year. That's always a headwind for the market. You look at taxes, likely going up, not down, after several years of kind of lower taxes in the US and Canada. You look at interest rates, likely heading higher, not lower. So the punch bowl, the stimulus from the Federal Reserve, the government spending, a lot of things are going to decelerate in 2022 and again in 2023. So I think it'd be a very rational call to make that things are going to be less exciting in the years to come than they were the last couple of years in terms of stimulus and positives. And the market always trades off the margin. What's the next incremental piece of news? What's the next change? And a lot of those key barometers are going to be going down, not up in the future at the margin. And that should put some significant pressure on the market. The final point will be, what does the Fed do? That's going to have a big influence in the short term, but the longer term, that is the reality. Things are starting to decelerate across the board in the US in terms of the positives that you've seen.
What will the Fed do? I want to take a deep dive there with you. But before we go there, you've been focused particularly on commodities these last few years. You consider yourself a contrarian investor. You entered gold at the end of 2018 when it was not in favor. So what are you liking amidst this environment? Like, would you be out of US equities now, Michael?
Yeah, it's a great question. So I've been a general portfolio manager my whole life. So I'm not one of those perma gold bulls that likes gold in every season, every situation. I've invested across all sectors in my career. I made a tactical choice to get long gold in 2018 when it's significantly out of favor. I saw a lot of debt in the US. I felt the next recession was going to be really ugly in the US. It would require a massive amount of money printing. I wasn't making a call on COVID. That was unbeknownst to me and all of us, obviously. But the recipe is the same. Every time the US gets in trouble, they print more and more money to get out of the mess they've made over the last 30 to 40 years. So gold thematically was a really good trade for me over a multiple year period, and it's extremely out of favor. As I look at the market today, I wish I could say that I loved more sectors. I wish I could say I was more positive on more corners of the market, but my bullish position on gold is more out of default setting in sense that most sectors of the market, any asset class you look at, real estate, high yield bonds, equities, most sectors of the market are extremely overvalued, feeding off record low rates. So my capital, I'm really being very defensive with it by putting it in gold, where I see undervaluation, lack of involvement from investors, very low valuations, high free cash yields. The rest of the market is very vulnerable to me. So I'm kind of sitting out on purpose, but I'd be happy to redeploy if the markets were to correct to levels where I found more attractive, but I don't see a lot of value in markets right now.
Okay, but would you be adding to your gold position now?
Absolutely. I think if you look at the free cash flow yield of the gold producers, you look at the valuation, if you look at the valuation of gold versus the market, so, take gold, S&P divided by gold, that's at, 15-year lows. Gold's never been so cheap versus the market. So gold on an absolute basis versus the market, one unit of the S&P 500 will buy you more gold bullion than it has bought probably 10 or 15 years today. And you look at the equities, the gold equities themselves, they're trading at a huge discount to where they should be based on $1,800 gold. So you have gold is cheap versus the market, and the gold equities are extremely cheap versus the gold price. So I see real compelling fundamental value in the gold sector today. And back to our back to school point, as portfolio managers come back to work in the fall and they look at what's going to perform really well next year, they may start to think about selling some of their high-flying tech stocks or cryptocurrencies or speculative stocks in their portfolio and rotating to what hasn't worked, which is gold that has really good fundamentals and very low valuation. There's not a lot of places you can do that in the market.